Welcome back to the Bitcoin Treasuries podcast. I'm Tim Kotzman here with Lyn Alden. Lyn, thanks for the time. Great to see you.
Happy to be here. Thanks for having me.
I thought it might be fun to start with some questions from the X community. So as of this morning, INFRA, was asking, how will the Trump administration reconcile tariffs being structurally bullish DXY with the fact that they need a much weaker DXY for reshoring? And also, what impact would Greenland and Canada have in a world of a neutral reserve asset?
So really good set of questions. I think the administration has a number of goals that they want, and some of them conflict, and some of them might be solved over time, and other ones are more fundamental. So one of the challenging things is they want to keep the dollar as the global reserve currency. But then they also want to reduce trade deficits when the way that the current system is structured, those trade deficits are kind of what allows the dollar to be the world reserve currency, because that's how dollars get out there for all these, non-US contracts to be denominated in dollars and for all those dollars to flow around. That's kind of a trade-off that they have to work through. The immediate one asked here was about the dollar strength and how some of these policies can be dollar strengthening, which can actually make manufacturing less competitive, and they're trying to reshore that. Probably the best answer we have from the administration is Stephen Moran. I hope I'm pronouncing his last name correctly. Is Trump's nominee for chair, is lead economic advisor, and he's written papers about this. And his view is that probably these policies are dollar strengthening in the beginning. They get some things set up, and then they can move to a cycle of a much weaker dollar, something like we saw in the 2000s or the 1970s. There's really only been $3 cycles ever since the end of the Bretton Woods era. So over the past 50 plus years, there've kind of been three strong and weak dollar cycles. So if they do a significant dollar weakening, after they get some tariffs or changes in place like that, that's one potential way to reconcile that, is that you can weaken the dollar while still being the global reserve currency. And the main cost of that approach is inflation. Basically, that it can conflict with some of their disinflationary goals that they have. As far as Canada and Greenland, that's more geopolitical. That's more minerals and economic size. I wouldn't really lump that together with the rest of these macro things we're talking about. That's more geopolitical. I guess one thing we're seeing is there's a potential argument that the U.S. power might withdraw more toward the hemisphere that we're in rather than kind of spread it everywhere. And so we might be a little bit less forceful across the ocean, but we might be a little bit more forceful, a little bit rougher with our trade partners back at home. We'll see if that becomes a more structural change, but that's a potential direction.
Shane asks, with QT coming to an end, how would that impact markets, liquidity, investor sentiment? Is it, in your view, already priced in, or does the front running begin sometime soon? Which kind of reminds me of something I've heard from Jeff Walton, which is everyone's constantly front running everyone else about everything all the time. So
I think we're already, so the effects of quantitative tightening have already been mostly nullified for about 2 years. So back in 3 years ago in 2022, that whole period was pretty negative for markets. We saw the Fed started reducing their balance sheet, and we didn't really have any sort of offset to that. So actual overall liquidity was drained, really bad for most assets. And then what we started to see in late 2022, and especially by 2023, is we started to see the Treasury offset some of the quantitative tightening. And the mechanism for that was that the Fed previously did so much QE that they actually kind of overstuffed the system with liquidity. It's like pouring water into a cup, and then even when you get to the rim, you keep pouring, and you're not actually filling the cup anymore, and you're kind of just getting water all over the desk now. And all that water was kind of swept into the reverse repo facility. That's kind of like where all the excess liquidity was put. And the way to get that out is to basically issue more T-bills. All that liquidity kind of represented excess demand for T-bills rather than T-bonds and other types of assets. And so the Treasury under Janet Yellen said, well, we're going to issue a ton of extra T-bills then, instead of increasing our issuance of coupons, of T-notes and T-bonds. And so they sucked about $2 trillion out of the reverse repo facility and put it back into the banking system, which is almost the exact rate of quantitative tightening. And so the actual level of reserves basically trended sideways for 2 years. And so I would say that we're this year probably we're going to see the Fed end their quantitative tightening. Um, we'll see if they go right back to gradual balance sheet increases or hold flat for a little while and then go eventually to gradual increases. But basically, I think we're going to see a handover from the Treasury to the Fed providing liquidity. But I actually don't think we're going to have a major change in underlying domestic base level liquidity. Now, there's other things that can affect liquidity, like the strength of the dollar we just talked about, the rate of bank lending, all these things that can affect broad money and global broad money. But in terms of that actual like base money management, I think we're basically going to see a trend change in the source of the liquidity, but not necessarily the size. So I think it's not a huge factor, even though it's something I'll be covering all year.
Node 21E6 wrote, meaningful structural change tends to happen only after a major, quote, reset moment, end quote, an event so significant that it forces a clear before and after and a shift in economic and policy thinking. Looking ahead, what kind of events do you see as imminent or likely in the near term that could serve as such a reset? What would be the key catalysts that make the pre-event models obsolete and force investors, policymakers, and institutions to fundamentally rethink their approach?
I mean, there's an argument that the past several years, kind of starting with COVID and then going into Russia's invasion of Ukraine and that whole period of time, that's a pretty big moment. It's not a World War II type of moment. Not everything's going to be on that scale. But in terms of kind of a shift, the kind of the approach that multiple countries took to the pandemic, the resulting kind of populist surge we saw against that approach, the inflation that followed from the monetized fiscal deficits. Obviously, it was a very politically charged thing. Lots of hot opinions on it. Then we have actual war happening on a fairly large scale, and then there's been a pretty big political shift. Now, one way that this could kind of play out is that instead of anything as big and decisive as we saw in the last kind of long-term debt cycle, fourth turning type of reset, it could take longer and just be punctuated by a lot of things of kind of that scale rather than anything of, epic scale, which I guess is probably the best case scenario is to, that big change requires probably a lot of things going wrong before they start going right. But generally speaking, most people would rather have a series of moderately bad things culminating in some, local climaxes rather than just one gigantic thing. So I would say that we're already kind of in that turn. And then the question is, how long does it take? And are we happy with what comes on the other side of it? I mean, sometimes when you have a turn, the when the pendulum swings far the other direction, people don't like where that went. That's kind of what we saw in the last, in the various 20th century fourth turnings, kind of how countries ended up basically was like, okay, you pivoted from aristocracy to communism. Maybe that wasn't the right direction, right? So instead of
Yeah.
aristocracy to republic, you went full on communist, and that was like the wrong pivot, and then you have to pivot back. So there are dark scenarios that can end up. But I would say I think we're already in this. I mean, that's part of my macro analysis was that the 2010s were in many ways a lot like the 1930s, looking at a bunch of different macro variables. And then the 2020s were shaping up like the 1940s, not in terms of hopefully any scale of that kind of, kinetic warfare, but in terms of the fact that when I was looking at the macro picture, I was like, this looks like wartime financing. And then the politically charged environment around that, it's a somewhat similar overall dynamic. So I think we're actually already underway in that kind of big change.
Hey guys, this episode is brought to you by OnRamp. Bitcoin custody is evolving. Both self-custody and single third-party custody come with significant risks and trade-offs. OnRamp is pioneering a new standard, multi-institution custody, which eliminates single points of failure, adding fault tolerance and redundancy to your setup. OnRamp secures your Bitcoin in a segregated, cold storage, multi-sig vault, guarded by 3 independent, institutional-grade custodians, none of which have unilateral control. Multi-institution custody removes the technical, mental, and physical burdens of private key management, providing unparalleled peace of mind for you and your loved ones. To learn more, schedule a consultation with the OnRamp team. Go to www.onrampbitcoin.com. Sound_money asks, what are your thoughts on Trump stating or alleging that U.S. treasuries have been tampered with and that our debt may not be as large as it looks?
So that was a headline that came out today, and I think they even already walked that back somewhat. So I don't know if there's a lot of context there to comment on.
Sure.
I think that part's pretty well accounted for. So I think it's not really it's an interesting statement to have said, but I wouldn't read too much into it personally.
Yeah, I kind of equate it to like every day there's going to be a headline out of this administration.
Yeah.
So you can pick and choose which ones you want to spend time on.
Yeah.
VEE commented SAB 122 versus SBR. And to me, that kind of, I'm curious to maybe form it into a question. Do you see the potential impacts of banks being able to custody Bitcoin as greater than the strategic Bitcoin reserve, and you could even throw the sovereign wealth fund into that, or how do you think about all of those potentialities and the reality of banks now legally being able to custody digital assets?
I think that depends on size. If the SBR or the the strategic stockpile, whatever terminology they end up ultimately settling on, if they at the small scale, just for example, ring fence the Bitcoin they already have, or at least the remaining Bitcoin that they don't owe to someone, and they say, well, that's our strategic reserve, we're officially not going to sell it. That's obviously that's a pretty small and not particularly impactful announcement. So I would say compared to something like that, banks being able to custody it and offer various lending on top of it is probably a bigger deal. On the other hand, if you had something like the Lummis bill go through, which I don't think is likely, but if you had something of that scale, like the U.S. government's going to buy like 1 million Bitcoin, in any given couple year period, that's massive because that could also trigger other sovereigns to do something similar. You'd now have an incentive to front run them. So I think that ultimately comes down to the scale, if any, of the SBR announcement. And then the other thing, I kind of tweeted this the other day that I think an even cooler thing would be to eliminate capital gains taxes on it, or to do various things to partially eliminate capital gains taxes on it, maybe a requirement like after a certain amount of time they go away, or under a certain threshold per year, so that you don't have to keep accounting for every little lightning payment you send or something. Those I think would not move the price as much, but I think it would increase the quality of life for a lot of Bitcoiners. And if anything, is kind of cooler. So I kind of put that subjectively higher. But then between the two you listed, I think it ultimately comes down to the size of the SBR.
And do you have any thoughts on what the reality of a sovereign wealth fund might look like and how that would impact Bitcoin?
So I guess I'm more cautious by nature. So I tend to assume the under on how that's, when we look back after 4 years and say, well, what does this look like? I don't really expect to get something like the Lummis bill in that period. Not to say that I'm not criticizing her for putting the legislation forward or the ideas forward, but I think if that's going to be the base case, it's not my base case. I think we probably end up something smaller, probably a lot of debate around terminology. There are a lot of people close to Trump that support other cryptos, so that could be murky. And some might even have an incentive to not push Bitcoin too hard. So you could have actually other crypto people saying, maybe a little bit of Bitcoin, but not too much. And now to your earlier point, when we talk about, dollar strength versus dollar weaknesses, one of the ways, ironically, to weaken the dollar is to print a lot of dollars and accumulate other assets with them. That's what like mercantilist countries do. So, for example, when Switzerland or Taiwan or whatever the case may be, when they're running big current account surpluses, instead of letting all that kind of pile up and strengthen their currency, they often keep printing the currency and accumulating tons of reserves instead. So you technically could use it as a big devaluation moment for the dollar, not like a you could drop the value by 10, 20% by accumulating a lot of foreign assets, of which Bitcoin could be a big chunk of that. So there are approaches where that could blend with some of the other things we're talking about. But kind of like until I see it form, I tend to assume the under and not, my bullishness on the asset is not necessarily contingent on anything like that within this investable time horizon. And anything that happens like that is kind of icing on the top.
That makes sense. Craig asked, could Bitbonds lower the 10-year Treasury rate and facilitate the economic recovery that Trump is aspiring toward? And maybe this, my understanding, maybe you can explain what Bitbonds are, is that would, be built on top of some sort of Bitcoin reserve.
I think in a world where Bitcoin's market cap is $2 trillion, give or take, and total US debt is like 36 trillion. Last I checked, we ran into the debt ceiling and we're kind of around that line.
Mm-hmm.
I think Bitcoin has to be bigger before you can do something like that. That's kind of a question that like El Salvador has looked into, and countries of that scale can say, okay, how can we do this? And then we see in private markets, there's been some interest in doing this. Like, hey, if we have like a real estate note of some sort and we have a Bitcoin component, could that increase investor appetite, lower yields? So I certainly think that while that is a reasonable approach, it becomes very hard when you're looking at a market that's so big. If we were having this conversation in 10 years and maybe Bitcoin is 10 times as big or more, it gets more interesting. But I think right now, basically, Bitcoin's not big enough. The US doesn't have enough Bitcoin. And I would take the under on them just kind of like aping into it and just buying tons of Bitcoin and driving up to $1 million a coin, in like the next few years. And so I tend to think it's an interesting talking point, but I think that it's probably not super relevant for the next few years is how I could be wrong, but that's my honest view on that.
A couple more from the X community. Orange Crush asks, do you think Trump will negotiate a Plaza Accord or Bretton Woods 2.0 and revalue gold and or take Bitcoin as settlement for trade?
I would think of it as the Mar-a-Lago Accord, because Plaza Accord was named after the hotel it took place in. So this is certainly, and it's something I've written about a little bit. It's certainly, I would think that the odds of that in the prior administration or the continuation of the administration would have been very low. In this one, it's probably a little higher, because Trump does have people in his orbit that want a purposeful currency accord, kind of a kind of stepwise dollar devaluation, maybe some sort of agreement with China, that kind of thing. And so I certainly think that's a serious possibility over the next few years. Some people have said that there was in 2016 leading into the dollar weakness of 2017, something like informally called a Shanghai Accord. And that's kind of like off the record. And it was less big than something like the Plaza Accord, but it something like some sort of currency agreement probably happened, and it did have pretty meaningful effects. I could certainly see that's kind of the lower level of thing that could happen, and that increases like something like of that threshold increases the odds of it happening. When we look at something major like a Plaza Accord, if we do start to see the strong dollar continue to impact trade balances, and if we kind of go, okay, we're a year or two in the future, we look back and say, okay, we did a lot of things, there's a lot of optical things, but the trade deficit's still roughly the same size, then we might get to more of those types of actions. So I do think it's a reasonable thing to be asking. And there are specifically people in Trump's orbit that are in favor of this. The question is, will those people get their say over people on the opposite camp? It tends to be kind of there's more of like a pro-industrial side and then a pro kind of finance side, and it's, which one's winning. And in Trump's prior administration, kind of the pro-finance side won, even though there were voices of the kind of the pro-industrial side. They just were kind of they didn't have enough center of gravity, I guess. Whereas this administration seems to be more in that camp. So there's a higher possibility.
This next question I thought was interesting, and I don't know if I even know quite how to think through it. So M. Lofgren, Folofgren, asks, do you have any thoughts on what effects primary or secondary Tether on the Lightning Network might have on Treasury market functioning and USD hegemony, and on whether a merger of Tether and Microstrategy is a strategically sound idea. I don't even know how to think about that one. So,
Yeah, so I mean, the challenge there is that Tether mostly operates offshore.
mm-hmm,
And as stablecoins become more normalized, we're going to see probably big banks in the US want in on it. Um, and you can see some tension there. And MicroStrategy is a US corporation.
mm-hmm,
Um, and so I think Tether and MicroStrategy are probably going to be separate, very large hubs doing their thing in the Bitcoin and Bitcoin adjacent space.
mm-hmm,
Um, as far as Tether on Lightning, um, that's that's kind of premature because first we have to see that take off at some scale. So Tether is already well over 100 billion, I think approaching 150 billion in market cap, and then you also have Circle. So total stablecoin, collateralized stablecoin market cap is already well north of 200 billion. Um, it's kind of like let's get to a billion on the Lightning Network first, and let's get to
mm-hmm,
5 billion and then we'll see. I mean, this is I think it's the more interesting question to me is how does that impact the Lightning Network? Because whenever you have a big thing and a small thing coming together,
mm-hmm.
the more faster changing thing tends to be the small thing. Um, and so the Light Network has far less capital on it than, I mean, even a fraction of Tether. So if you saw any meaningful share of Tether's current circulating capacity go from Tron and Ethereum over to Lightning, or even if the other two stay the same and just Tether keeps growing as some of that growth is on the Lightning Network, um, that has also implications for Lightning liquidity, Lightning popularity, the types of apps we could see. Um, Even fees on Bitcoin could be impacted over the longer run by having that just more throughput, more activity. I think that stable coins in general, regardless of where they are, the main question is as you go from 100 billion to 200 billion to 300 billion to 400 billion, maybe up to a trillion or more, that starts to be a notable buyer of treasuries.
Mm-hmm.
And as we generally see, foreign central banks on net are not buying treasuries anymore. They haven't for like 10 years. Um, Now, foreign private buyers are still somewhat buying, but not at the rate of issuance. So foreign holdings as a percent of U.S. debt is lower than it was 10 years ago. Um, but there's still very strong on the ground demand for dollars in countries around the world. And stable coins are basically a way to say, okay, well, maybe your leaders aren't accumulating dollars anymore, but you still can. And so you have like a kind of a new source of demand for dollars slash treasuries. And I think that still has legs to it. So I think that I wouldn't be surprised to one day see stablecoin market cap at over a trillion. And that's a marginal source of demand for treasuries. And I think it's part of what keeps the wheels on the train, on the tracks, keep going for a period of time.
Scott Simpson asks, what are your thoughts on, if any, on the Bitcoin power laws that kind of uh, model out supply,
Yeah,
demand, pricing, and you have these conversations on social media where people are, subscribing to it or not subscribing to it.
I tend to think that a logarithmic view makes sense with periods of over enthusiasm and then deleveraging and undershooting. So any kind of model that looks something like that is going to be somewhat relevant, I think. Um, the power law model is more conservative than some of the other models that have been put forth over the years. Um, I tend to agree with it in terms of like where they view price in 5, 10 years in a very big band makes sense to me.
Mm-hmm.
Um, I tend to caution against getting over enthused on models. And I kind of scratch my head when I see people just like arguing aggressively at each other, like this model, no, this model. It's like, at some point, you can trade your own book, and if you're super confident in a model, you can make money from it. And there's shrinking returns of trying to convince other people that Bitcoin's going to follow this specific model, especially because the models are pretty wide in terms of
Mm-hmm.
like what price could look like in any given year. So uh, it's not that I think Bitcoin's necessarily going to fall out of like the power law banned anytime soon? My guess is probably not. But it's not something I regularly cite or reference. I mean, I did a piece once where I kind of looked at power law estimates going back to like the first one, like over a decade ago, and kind of like just tracked it. So it's something I have looked at. This is not something I'm super supportive of. I think that, all models are like they're all wrong, all models, but some of them are useful. So
Hmm.
if it helps people to kind of see a logarithmic chart and these kind of structural increases over time, then so be it.
Got it. Alex EB, I like this question. Is now the perfect time to swap gold to Bitcoin?
I think it depends on who you are. I'm not generally one of the ones that puts them in conflict because they're both tiny markets in the grand scheme of things. I mean,
Mm,
total assets worldwide are something like 1,000 trillions, like a quadrillion dollars of assets. And gold is like a 20 trillion market cap. And Bitcoin's like a 2 trillion market cap. So these are drops in the bucket. I think actually both of them can grow into the bond market. We've already seen gold is just relentlessly outperforming Treasury bonds for years throughout this whole kind of, this whole like pandemic and aftermath and lockdowns and inflation and all that. We've just kind of seen this massive devaluation of currencies and bonds relative to gold. And then also even more so against Bitcoin as a smaller, faster growing market. Um, some people say like the US should sell its gold. I generally view it as like if you're the United States and you have 8,000 tons of gold, there's really no reason to ever get rid of it. It just stays there forever, basically. Assuming it's still there. We don't, unlike Bitcoin, we can't do like proof of reserves as easily.
mhm.
Um, uh, an individual, I mean, if they're like massively overweight gold, and they've been like a massive gold bug for years and they don't have Bitcoin, I'd be like, we probably should have some Bitcoin. It's ma massively outperforming gold over the the lifetime of Bitcoin in any given 4 year period, pretty much. Um, but I think indiv investors of different ages are going to have different opinions often, or how much work they've done on Bitcoin as a new asset.
Mhm.
And I put them a little bit less in conflict than many other pro Bitcoin people do. And I kind of say, that's like Goku and Vegeta, they're going after someone else. They're going to fight Frieza, so they don't have to fight each other.
Yeah.
And so I think that the bond market and the overall hundreds of trillions of dollars in the whole fiat system is kind of what these types of assets can eat into.
That makes sense. Last question from the crowd. Happy Hodler asks, and this is a different question. I kind of like it. What are you most grateful for?
I'm grateful that I can do the type of work I do, that I can work on things I find interesting, that I have the freedom to work on what I want to work on, um, that I live in a place where I can publish articles and books about the things I find interesting. Um, that I'm able to go and meet a lot of the people that are working in the Bitcoin space or um, just kind of all in this field. I've been very grateful for the access that I have to talk to various people I find interesting in the space, um, and that I have a lot of flexibility in working on it. It'd be. I mean, it's just an interesting time. It's like that kind of quote is "May you live in interesting times," which has two
Mm-hmm.
sides of it because it's kind of like not necessarily a good thing, uh, but it's generally speaking, um, seeing kind of big changes happen and trying to be on the right side of those changes and having the luxury of being able to kind of analyze and work on those changes is just very exciting. So I'm grateful for that.
The Bitcoin for Corporations conference is coming to Orlando May 6th and 7th. Receive 20% off admission by going to microstrategy.com, selecting Bitcoin for Corporations, and using discount code KOTZ at checkout. And I'll see you there. Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. This is close to what we may have already covered, but as we've all seen, several analysts are anticipating Bitcoin attaining a price of $150,000 to $250,000 maybe this year. And then they kind of throw up their hands and say something similar to like much higher when you ask, well, what happens if there's the banks are coming in, the strategic reserve, a sovereign wealth fund. And even Larry Fink mentioned like something as high as $700,000 Bitcoin in a recent interview. So I guess without getting into price predictions, do you generally agree or disagree with these ranges? I know we've already talked about the power law sort of spectrum, and what could be some of the biggest or most obvious catalysts in your mind.
Yeah, that's generally how I think of it, is that I think we'll see, low six figures. We've already touched it, but I mean like further into the low six figures, like some of the early numbers you referenced, with the caveat that there are various big Boolean outcomes that can happen that can drive you to much higher prices in a shorter period of time. I tend to expect this cycle to probably be a little longer than average. That's kind of where my current view is. If you asked me a year ago, I would have said maybe not, but currently I'm thinking that this cycle might be a little longer, and that maybe the trade-off is that it's less explosive in any given part of that. And so, some of the numbers you referenced, maybe we'll see it this year, maybe we see it next year. I think as we've kind of shifted more toward fiscal dominance, you could have a more sustained, longer running issue. Like watching gold, if you look at the gold over TLT chart, so gold over long duration treasuries, it's just been grinding up for like so long. And even there are periods where gold kind of pauses, but then treasuries kept falling. So that ratio was like surprisingly smooth and upward. Bitcoin could kind of surprise to the upside, not in terms of like explosive magnitude, but in terms of just like how long it goes this time. Even that's not a high conviction view. I mean, anything can happen. I kind of look at it just over time. I kind of think, okay, well, do we have danger signs yet? And I look at various indicators like, market capitalization compared to on-chain cost basis. Is that extraordinarily high levels? No, it's kind of looks like the mid cycles looked in prior cycles. I look at things like the HODL wave, how much, whenever there's a bull market, it convinces some old hands to sell their coins. And either maybe they're rebalancing, maybe they're upping their lifestyle. But either way, that they're having a lot of exit liquidity, and they're taking it. So far, this HODL wave has been smaller than prior cycle endings, meaning that the price action's not been enough to get a similar amount of coins to rotate to new hands as we saw in prior cycles. Doesn't mean every cycle has to be the same. But in general, I think we probably have much higher to go in the cycle. I'd expect 150, 200K, hopefully. And then when we hit those levels, I'd have to see, well, what does it look like? I mean, if you go there in 6 weeks and the market cap compared to the on-chain cost basis is now like super high ratio, I'd be okay, this is looking kind of dangerous now. Whereas if we see that figure in 18 months and we've seen the cost basis go up and it's been this more orderly incline upward, then I might be more bullish and say, well, maybe I think we still have higher to go. So I generally agree with the way you phrased it, which is kind of conservative targets, which is funny when you hear conservative, because it's like, I mean, calling for a double in the next couple of years is like conservative in Bitcoin terms, but that'd be amazing for any other asset. With then caveats that, sure, I mean, as a scarce asset, and as something that big governments can change their opinions on, then sure, you can have far more explosive actions.
And I guess we can also throw in that there was no Bitcoin Super Bowl commercial, right? So that means we're nowhere near a top, maybe.
Hopefully, yeah.
There was a SEC filing recently stating, well, you can take away from it that BlackRock increased its ownership of Strategy, formerly known as Microstrategy, to 5%. Is that bullish in your view? Is that just business as usual? Like just BlackRock owns a lot of stuff. They own a lot of stuff. Or is that just kind of like a non-news item to you?
I generally put that in the non-news item category in the sense that as MicroStrategy gets bigger, and then not and especially as it gets bigger and then stays bigger quarter after quarter after quarter, and gives kind of rebalancing and things like that time to happen. It makes sense and to show up as a bigger holding in their funds. They're a big holder in like most fairly large U.S. companies. So it makes sense that that's now that MicroStrategy is in the Nasdaq 100, and as it's kind of just it's an increasingly large, very liquid stock. It makes sense that BlackRock and their various strategies would be in it. There might even be groups in BlackRock that don't even talk to each other, and they, for different reasons, increase their allocation. Could be active decisions, could be passive decisions. They have a whole bunch of different fund types. So I think that's more a sign that just MicroStrategy is becoming bigger. It's getting in some leading indices, and it makes sense that then BlackRock holds a chunk of it.
Could you explain the difference between monetary debasement and inflation? Because some have used the terms interchangeably, but they're different, right?
Yeah, I've done articles on this. Sometimes that comes down to who you're talking to. Like, if you talk to an Austrian economist versus like current mainstream economists, Austrians will generally refer to increasing the money supply. Like they'll kind of say inflation is debasement. Whereas the modern term for inflation mostly refers to price inflation, especially consumer price inflation. Like is a basket of typical goods that a middle class family buys, is that what I wrote rate, is that increasing or in rare cases decreasing? Um, I've written articles about this where I break it up and say, instead of semantics and talking past each other, let's just define different types of inflation. So one is monetary inflation itself. That's debasement, and that's a prerequisite for most other types of long run inflation. Um, and so you can, like, something like a war or other thing can give you a temporarily dislocation in prices, but if you're not structurally increasing the money supply, you don't see prices across the board structurally increase. You might see one area increase, and then demand reduces elsewhere, and that's deflationary. And then after some sort of like struggle, you go back to something looking like the prior status quo. Whereas when you get these persistent long run price increases, that's largely driven by debasement. Like if you look at it like a century long gold oil chart, oil in dollars, it'll be these like structural increases, then plateaus, and structural increases and plateaus, and you go up like 100-fold since, say, the creation of the Fed. Whereas if you look at oil priced in gold, it's this big zigzagging sine wave where sometimes it's higher, there's either war or rapid growth happening. Other times it's lower because there's recessions or plenty of abundance of oil, and you're just kind of in this band. Um, and that's kind of the main difference. So I would say that another way of thinking about it is that because of technological productivity, the technical kind of price levels should be getting lower most of the time. Outside of major wars, the fact that our technology and organization improves over time should drive prices down. And so zero price inflation is not the baseline. Like something like -3% a year, and it changes over time. That's kind of the baseline. So if you have, 7% monetary debasement per year, and price inflation's 4%, basically you're getting 4% above zero, but 7% above what your baseline probably should be, which is falling prices. And I think that's one of the ways to kind of think about it and kind of separate all these things. That if you get a lot of money supply growth and debasement happening, you're going to get inflation somewhere in other things. And the question is where. If you don't have commodity bottlenecks or labor bottlenecks, then a lot of that money printing is probably going to end up in financial assets. So the price of homes, the price of equities, the price of gold and Bitcoin, all that's going to probably go up. Whereas on the other hand, if you do have some of those fundamental bottlenecks, commodities, labor, supply chains, things like that, then more of that money printing is likely to show up in higher prices of consumer goods and other raw materials, and less so in financial assets. So at the end of the day, a lot of it comes down to debasement. And then the question is, where does that debasement show up?
I have a question here from a friend. And the question is, why do you think Ray Dalio doesn't get Bitcoin? And just curious your view on, like, he said he confirms he owns a small amount, but he views it as a form of alternative money and a tool to diversify his portfolio amid concerns about depreciation of fiat currencies. But despite those holdings, Dalio's expressed a preference for gold. He sees gold as more dependable as a store of value. I guess, do you share this view? Do you think this view of his will evolve over time? Why or why not?
Well, I hesitate to speculate about someone that I don't know him personally.
Sure.
Um, I think one, just investors in his age cohort tend to not be as either learned about Bitcoin or excited about Bitcoin as younger investors. There's multiple exceptions, of course,
Hmm.
but just the odds are not starting in his favor in terms of investors that tend to be bullish on Bitcoin. Um, his circle that he goes to is very kind of establishment in a way. I mean, he goes to Davos, he goes to, he's very tied into a lot of like politicians and academic figures and that's generally a pretty anti-Bitcoin set of viewpoints that he's often with. Um, and so I would say the fact that he's because he knows debasement so well, I've read, he's done a lot of research on that. His firm's done a lot of research on that. And because he likes gold and stuff, he's somewhat primed there that he starts from understanding debasement enough to find scarce assets interesting. Um, and I think this is where he ended up, which is basically that the number of kind of frictions against Bitcoin he has in him and around him has just not been well overcome. I would assume that he's not read five like dedicated Bitcoin books, for example. Maybe
Hmm.
he has, so that's why I hesitate to speculate. But
Sure.
I just think there's probably so many things that he's thinking about and dealing with that this asset, despite its good performance, it's a $2 trillion asset. It's technology, which is not particularly, as far as I know, his strong suit. Um, it's understandable that he feels more comfortable with gold.
Hmm.
Um, and I think it's part of, I think he'd have better returns if he was more into Bitcoin. Um, but that's just I think that's a thing that happens over time. I mean, sometimes people will be just reluctant to change their minds, and decades will go by, and new people will be in that older cohort that have just kind of always known Bitcoin, um, and kind of like how he's always known gold. So some people change their minds, and other times, just a generation has to kind of rotate for these things to really take hold.
That makes sense. How do you see Bitcoin fitting into a traditional investment portfolio over, let's say, the next decade? I mean, you have BlackRock now, in their reports touting a 1 to 2% allocation. Do you think Bitcoin will have an allocation more like digital gold in portfolios or something else entirely? And keeping in mind something that I have heard a theme of and maybe just learned over the past little bit is that a 5% allocation to anything in a traditional portfolio is like kind of the max in a traditional portfolio. And correct me if I'm wrong or you have other views.
Yeah, quote unquote traditional portfolio is super diversified. The biggest slice might be, 20% in the S&P 500. But then if you look and say, well, what is that in any one stock? It's a few percent,
Hmm.
even for the biggest. And so, 1, 2, 3, 4, 5% is all relatively meaningful. In one thing I do in my research publications is I have some model portfolios that are kind of they're traditional portfolios with a slight tweak to them. And one thing I've generally done is say like, at the bond side, because I've been bearish on bonds for like 5 years, I say, well, let's take out some of the bonds and put it in gold for like a similar volatility profile but better. And then I
Hmm.
said, well, for some of the equities, let's take some equity chunk and put it into Bitcoin because they did research on Bitcoin and decided this is a high probability network to keep appreciating in value, and it's outperformed most equities. Um, and so that's the approach I've taken. Um, and I've done higher than that BlackRock figure. But for example, the number that I put in a quote unquote traditional, portfolio is different than my own personal number. As someone who's immersed in the ecosystem, has written a book that's partially on the subject. Um, I'm comfortable, and in my age, I'm comfortable with a fairly high allocation. In addition, appreciate when it appreciates and you just don't sell, that can just automatically give you much higher allocation. It doesn't mean you necessarily you put that much in to begin with or that much of a percentage in to begin with. So I think that yeah, we start with the basics of get off zero, and then have it more normal for portfolios to have a Bitcoin slice, and it could be 1, 2, 3, 4, 5%. But when you look at the sheer size of the capital involved, that's actually huge. Um, Now, the counter argument is, and this is something like, say, Michael Saylor would argue, if you're going to put 2% of your portfolio in, like, what's the point? Like, if it, like,
Yeah.
how many other high conviction investments are you going to get? So I would say that the quote unquote traditional equity, the traditional portfolio is kind of like when you're not conviction about anything. It's like you have no views of the future, and you just kind of say, "Oh, I want stocks and bonds and gold and Bitcoin and foreign stocks and all mixed up together." When someone puts 100 hours into something and says, "You know what? I think." So this is 10 years ago. You think Apple stock's going to do amazing. I want to own Apple. Or you look at Bitcoin. You say, "You know what? I think Bitcoin still is one of the best bets over the next 5, 10 years. I want to over allocate to it." That's the approach that I take. Um, but that's not the traditional equity, the traditional portfolio view. So I think that small allocation in a traditional portfolio as a baseline makes sense, and then dial it up if you actually have conviction.
Makes sense. Do you see any trends in the corporate Bitcoin adoption? And how do you think through the risks and rewards of Bitcoin treasuries for businesses? Like, should they think about it any differently than an individual would or a sovereign would?
Well, I think that's the trend that's kind of finally taking off a little bit. That didn't really take off in the last cycle. So Microstrategy would hold conferences, and no one is really joining them. And I think because of some of the accounting cleanups that happened, as well as just going through a full another cycle, and seeing one company really disproportionately benefit, like the only company that kept up with NVIDIA in terms of performance. Um, it makes sense that other companies are doing the same. Um, and so I think it is good that we're finally seeing, multiple companies in multiple countries adopt this. I think it's going to continue. And I wrote a piece about this to point out that there's actually a really big gap between Bitcoin and any other asset they could hold as a treasury asset. So any asset that underperforms like the cost of capital for equities, meaning basically expected equity return, which you can in the US you can benchmark as the S&P 500. If you have an asset that you expect to underperform the S&P 500, you can really only hold so much of it. Um, and so gold has historically underperformed, not by a lot, but by some, and it's kind of by the amount equal to its debasement rate, like which is for gold like 1.5% a year. Um, and Bitcoin can basically, if you kind of take gold and you take out the debasement rate, that can kind of keep up with equities. But then Bitcoin has additional kicker that many of us view it as still early. So it's nowhere near its total addressable market. So it has still to go this period of heightened growth before it reaches whatever its kind of total addressable market is. At that point, it will probably go up with debasement. Um, and so companies realize it's a cheat code. It's basically something they can do to say, look, our income, we can only do so much with our income. We're not Microsoft, but instead of just holding money in treasuries or buying back shares and just kind of slowly melting, we can buy something that realistically could go up 10x in a time frame that matters for our investors, and it could change the scope of the company and kind of end that slow melting that many value stocks have. So I think that trend has legs to it. I think it makes sense. As far as versus individuals, I don't think there's a big difference. I think what both camps have to do is say, because this is a volatile asset, I can only put enough into it that I'm fairly sure I won't have to sell for 5+ years. So you don't want to be caught putting everything into it and then, oh, it's this bear market and I lost some income and now I have to sell some Bitcoin at a lower price than I bought it. That's a mess. So you have to balance your bullishness with your volatility expectations and your cash flow expectations. And that's true for both households, um, companies, and maybe to a lesser extent governments. But basically, any sort of private entity has similar things. The only thing is that the bigger of organization you get, the harder it is to actually implement that strategy because you have to get more people to agree. So a
Mm-hmm.
household, one or two people can make the call. Small business, sometimes one or two people can make the call, or a few people. A publicly traded company, but where the founder is still running it and owns a lot of it, that's again, you can make a pretty decisive decision. But when you have like a really broad decision set, it just makes it harder to get done.
Definitely. I guess we'll end on this. What advice would you give to someone just starting out in Bitcoin and markets today? And I'll underline that many of my guests have pointed to the Bitcoin Standard by Saifedean and your book, Broken Money, as great resources. Are there any other books or resources that you use and that you share with other people if they're just either beginning their journey or just kind of coming along?
Yeah, I mean those are really good ones. In my view. So I mean Bitcoin Standard's like the GOAT of the space. Broken Money has been a really good seller since it came out, and it's to my knowledge the most comprehensive single book in the space, probably in terms of like if you look at financial systems plus Bitcoin. There are also a lot of really good short reads that are still very relevant. I mean, not everyone's going to sit down and read a 500-page book. Um, it also like if you're getting into yourself or you're getting someone else into it, tone matters. So like there are authors that are more, I guess, assertive or aggressive in how they phrase things, and authors that are more like, cautious in how they phrase things, and those can work for very different audiences.
Hmm.
So whether or not you're trying to reach like an institutional audience versus like a blue collar audience, it could be quite different. Um, and so I think that one is find someone who sounds like they make sense and read whatever their core pieces are on the subject. But I think the ones you mentioned are kind of some of the go-tos currently. Um, and then I think a lot of it is just don't overcomplicate it. So like everyone thinks, well, I got into Bitcoin, what can I get into next? And then that's when they get into like trying to trade like meme coins around, or they get into leverage that is probably over their head, or they just kind of like keep it simple, don't overcomplicate it. Um, Always be aware of your volatility limitations. If you find yourself awake at night because your position's too big, then maybe your position's too big. And you ironically could end up with more Bitcoin with a smaller position if it means you don't make mistakes with your position. You know, if you end up having to sell at the wrong time, that's worse than having bought a little bit less and just letting it run. Um, and so I think just educate yourself, go slow, try to learn from different sources. If you see people that disagree with each other or that disagree with you that sound rational, lean into that, explore where the different points of disagreement are, rather than kind of stick in your own echo chamber. So seek out steelmen or seek out devil's advocate argument against whatever your position might be, and make sure you're fully comfortable with it.
Is there anywhere online that you want to point people to find you other than at Lyn Alden Contact on X?
Yeah, people can go to lynalden.com. That's my hub. They can also find me on Nostr if they like decentralized social media. Primal.net/Lyn. They can find me. And thanks for having me on.
Great. Thanks so much. And hope to talk to you here soon.
Sounds good.